Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, welcome back from Nashville.
Made it back.
How's everybody doing this week?
Didn't come away with a country accent, I promise. It was a good trip. Rob and I got to go to a very specific for life insurance summit or conference event, and learned a lot, took away lots of good nuggets, and also got to even feel like challenged on some of the things that we teach and are confident about, and reinforce a lot of things that we know to be true in infinite banking, with these specifically properly designed whole life insurance contracts that we help our clients with. And so walked away feeling great, even though there were some challengers in the room, which is just always to rethink your thinking and make sure you're on the right track.
Yeah, it's always great when you can just get some just new information from guys who are really helping people out, and guys and gals that are helping people out. And that's from years, a lifetime of experience. And it's reassuring to know that you get to just when you get to see folks like that in person and talk to them and hear from them that following this method and model and process, like, it works. It helps families. It protects families. It generates wealth. It generates capital that can be then utilized to expand the growth of the family. And yeah, it was a really good conference.
Excellent. Well, I'm sure you guys are happy to be home and ready to get back to it. But guys, in this episode, we wanted to talk about valuing your capital. So, John, I'm going to turn it over to you to start. What do we mean, one, by capital? How do we value it? What should we be thinking about our capital?
Of course. So in this episode, capital, we're going to regard as just purely cash or dollars, and the value that we can get from it, right? And in infinite banking, we talk about, building your pool of capital, capitalizing your banking system, and creating then an opportunity fund or a pool of capital or cash to then create additional opportunities, create additional value. So that's what we're talking about with capital, right? Is simply, if you want to put it in a very, very granular context, it's paying your premium over a period of time to build your cash value and have a pool of capital like we're talking about. What we want to talk about is in all contexts, like understanding that each dollar, each unit of capital has significance to it. And that each dollar, you have choices, right? We talk about often in infinite banking that everything, you finance everything you buy, whether you pay interest to a lender or you give up the interest that you could have earned otherwise for a lifetime. I always like to add that, for a lifetime. And so with that, we just want to talk about, opportunity costs. We want to talk about value of each dollar and how that translates to our lifestyle and to the decisions we make as a family, right? I think about my family all the time. Anytime there's a major financial decision we make, the last thing in my mind is like behavioral design and stuff like that. Really, one of the priorities I think about is like the significance of those dollars that are leaving my world or that are being used for something else. So that's going to be our discussion, is just talking about how we view and value and see the significance of each dollar.
Yeah, that reminds me. John, about the value. We're valuing our dollars. The first thing that came to my mind is we did our episode in August called "The Process of Infinite Banking Proven," and the that thought of valuing our dollars. One of the gentlemen I follow and I use his calculators. His name is Todd Langford, and one of the things that phrases that he used that just really has every time he says it, it just grabs my attention is, do you value your own family's dollar as much as you value the banker's dollar? In the sense that if you're going to be an honest banker, if you pay something with cash, that capital, if you use your capital for something, do you value your dollar as much as the banks in the sense that you will pay yourself back? That dollar you have is not free. It has value. It has more value, I would argue, because it's your family's dollar. And so if you're using your capital to do something, to buy something, to fund something, be an honest banker and pay that principal back with interest. That's one aspect that I see of like a tangible way of how do you value your own dollar more, your family's dollar more than you value the bank's dollars, which I would argue you should.
Yeah, excellent. Yeah, especially when we start talking about interest and interest rates and borrowing costs and those sorts of things, to start thinking like, okay, how much value can I actually generate from my own capital or from the life insurance company's capital
Hmm.
to help me build wealth? Um, what's the biggest roadblock, do you guys think, in somebody's mind when you start having this conversation about valuing capital?
I think a helpful parallel is in our, primary homes, building equity, and the trade-offs that you have to consider when you're trying to extract value, right? So lots of people they pay down their mortgage, maybe their home appreciates over time, and say 10 years into it, you're looking at a good chunk of equity in your home. And so many people, I think the majority of clients that I have and majority of people that I know that own their home have lots of equity and um, desire to use it, right? They don't want it just sitting in the walls of their house. They want it to be doing something for them, right? Um, and so the trade-off, calculation is, okay, well, I can access that equity by selling my house
Hmm.
and taking the proceeds. And now, yep, you have it, but also you don't have your primary home anymore, right? You have to figure out what the next housing situation is. Um, but you got the proceeds. So that's one option. The second option that I see many, many people opt for is to borrow against the equity. Most people do a home equity line of credit, a HELOC, and the value in that is that you get to stay in your home. You get to keep maybe the cheap mortgage that you got, early on. Maybe you get to maintain the family memories that you have. Like there's all sorts of value in keeping your primary home. So that's something that you're going to prioritize. But you're also trying to prioritize the value to extract from the equity. So of course, the natural, like easy thing to do is go to a bank and ask for the HELOC and access however much, 100K, 200K, whatever it is, and then leverage for something hopefully that's going to produce more income or cash flow or be an asset for you. Um, so that then you can even compound the value that you're getting, right? Um, and many people are totally think it's reasonable to pay interest on that line of credit, right? Because they
Hmm.
know, oh, well, I could, I guess, go no interest, but I would have to sell my home and, then use the cash proceeds for something else. But I don't want to do that. So I'm going to, have that trade-off and pay interest for the value that I stored in my house. So I really drew that out just to say, like, there are trade-offs to selling. There are trade-offs to withdrawing and losing the value that you had in the first place, especially if you start early. Therefore, translating into infinite banking and a properly structured whole life insurance policy, your capital is being stored in probably the most optimal place in the market out there.
Yes.
Um, and so now that you have these dollars stored, earning for a lifetime, protected for a lifetime, giving you protections with your death benefit, and maybe disability waiver and all sorts of other benefits that you get for a lifetime, you now have the choice, just like selling your home or not, to sell your contract and withdraw that value that you work so hard to build up to, that you may not qualify for again in the future if you're not healthy anymore. Or you can just, at a much lower rate, by the way, than the HELOC, and a much better, terms and control, borrow against that value and not interrupt the benefits that you got in the first place. And yes, it's reasonable to have an interest rate associated with that, just like it's reasonable to have an interest rate associated with the HELOC.
Mhm.
So I really broke that down, I think, much longer than I probably should have, but I just wanted to create that picture and that analogy, that there are trade-offs to selling something that you already have, an asset that you already have in place.
Yeah, and then before I knew the value of my capital, um, I had a whole life insurance policy, a standard whole life, and I got it back when I was I don't know, 15 years ago, before I knew about infinite banking. To as a I went into a project with my family, and I want to just make sure that if something happened to me, that my portion of it would be covered. We bought a family cabin together, and I had that policy, and I cashed it out. I needed the capital. I didn't even No one taught me that I had created this banking system. I had a little banking unit, little banker, banking unit working for me, generating capital, and I didn't realize what I had. So I killed my first banking business out of ignorance. And I just didn't, yeah. And that's actually, that kind of comes back to what drives us, and we're passionate about, is making that people aware of the opportunity they have to just create your own family banking business through early cash value whole life insurance. That is this, you're putting this business to work. Nelson calls it, your banking system. You're creating your banking system, your series of banks, these businesses that are generating capital for you. And yeah, and it just, that starts to build in your pool of capital that you're, like you said, John, you're protecting your family. You have all the benefits that come with these contracts, the riders, the disability waiver rider, to protect the creditor protection in many states. I mean, just we could go on and on and on. But that you're really truly wrapping your capital with this extra value. You know, I work with and Derek, you work with, we call them VARs, value added resellers, or suppliers. There's value being added around your capital by putting it into the most efficient place, and you're adding value to your dollars versus just being so kind of happenstance about it, making kind of uninformed decisions. So that's like our passion is to just help our clients see what they can do with their dollars.
And when is your capital most valuable? Is it right away today? Thinking about inflation and kind of the effects that that might have on the value of our dollars, or is it 30 years from now when I'm at my age, I might be looking at retiring at that point. How valuable is my capital, or what should the value of my capital be today compared to 30 years from now? What are your guys' take on that?
How would you define, like, what is value in that case? Are you saying to be used for something, or
Yeah.
what do
Yeah.
you define?
Think of it maybe as like purchasing power. Is my capital today going to be worth more than it is, is $10,000 today going to be able to achieve more for me than $10,000 in 5 years from now?
100%.
So what do I need to be doing along the way to kind of preserve that purchasing power, whatever that capital can achieve for me? What should I be doing?
Putting it to work.
That's us. Say put it to work.
I've actually been sitting on dry powder capital for a couple of years now, and capitalizing my system. I've been very happy with that. I'm seeing how my policies are growing. This has been in the first 4 years of these policies, so they're still relatively young. And now I've got what I think is a sizable amount for most people. They would say, "Wow, that's a decent chunk of change that you're sitting on." And so I've got to start pivoting instead of just thinking about capitalizing my system. Now I'm beginning to say, okay, how can I put this capital to work? Uh,
Hmm. Yeah, that's actually a very for our clients or prospects, that's a very common thought process progression when you start your infinite banking system with your family is just don't be afraid, as Nelson says, of becoming your own banker. Don't be afraid to capitalize. Think long range, right? And so you just take that first step, start where you're at, take that first step, start making deposits, premium deposits into your family system, protecting your family, but then just build, just capitalize. You don't feel like you have to use it right away. Just capitalize. And like you said, Derek, same exact thing happened to me. I was 4 years in, 4 or 5 years in, and then I'm like, wow, I have acquired a significant chunk of capital.
mhm.
Um, and this desire then all springs up in you. I need to put this to work.
Yeah,
It's just sitting here. I need to do something with it. And it's just it's a God-given impulse that, okay, you've built this capital. Don't let it just be lazy and idle. Go put it to work
right.
and start, building and benefiting and blessing your family, blessing others. And yeah, it's a very natural progression for folks when they start this banking system in their family.
Mhm.
And to both of those stories or, processes, what's the best thing then you can be doing while you're capitalizing is investing in yourself and
Mm,
educating so that, man, when that capital is ready to deploy, maybe you're now
yep.
at 100K or 50K or even 10K. I think you could do it with 10 for some cases, but like you've built now a mindset that is sharp and ready to go. You've now built maybe a skill set if it's you're able to start a business, or now you're able to be in the right rooms, masterminds, different groups that then have deals come to you. All the while you've been capitalizing, and now hopefully your knowledge is always outpacing your actual capital, your actual status, so
Mm,
that you just apply that knowledge and you put the capital to work, and it's just a peaceful transaction rather than the flip where maybe you hear people all the time and win the lottery and they
mm,
don't have any idea what to to do with it. They spend it within 10 seconds probably.
Yeah.
And so you want that knowledge gap to be in your favor so that when the capitalization period is significant enough, and you're ready to go, you're ready to go. And it's a peaceful, meaningful transaction or, opportunity for your
Mhm.
family.
yep.
Yeah, it's definitely, as the longer I've been in this space and longer I've capitalized the system, as you said, John, the more you educate, the easier it is to sniff out a bad deal from a good one. Um,
Hmm.
to realize like, no, that's not the opportunity that I want to take advantage of. And that's the one of the values of having patient capital is to be able to pick and choose.
Yep.
And
Whereas where the traditional mindset is those dollars have to be working to 110%. You always need to be extracting as much and much value rather than having that patient, steady mindset, the secure mindset, the I'll take advantage of the really, really awesome opportunities instead of taking advantage of the meh opportunities as they come up.
yeah, and then the nature of having to pay interest for borrowing against your cash value is in and of itself a really helpful buffer or filter or moment of pause to say, is this opportunity actually worth it? Is it
Hmm.
going to produce the value at a minimum, the interest that that's being charged to this,
Yeah.
but hopefully, triple what it's being charged, and it gives you that second thought, just like you probably would with a HELOC. Say, is this actually going to produce the value? Am I
Hmm.
going to want to pay this interest for what I'm actually using it for?
Yep.
So I think it's just another helpful, barrier.
Yep.
What other topics or comments would you guys have to say around valuing your capital?
And just say it's much easier to spend from a liability, something that's losing money for you or depreciating, such
Yeah.
as a 0.001% checking account, it's much easier to spend out of that than to spend out of an asset, right? And so if you can capture as many dollars into an asset, i.e. properly structured dividend paying whole life insurance, then it's going to give you just a much better structure and framework for where to deploy your capital and to be patient to use it for the right things.
Mm-hmm.
Yeah, and to touch on one of the things that we learned about at the conference, there's a product called Currents, and this kind of, it's not a novel idea, but it's a novel, I'd say, application. The idea of being conscious whenever your income is increasing, to be conscious about putting a portion of that increase into a place that can be generating, that can be growing. But what we typically tend to do is we just put all of our dollars into a spending account, checking account, and so it just gets unconsciously spent. That's just the nature of what all of us do. And it's just this kind of nebulous account, checking account. It just gets stuff comes, things arise that we need or want, and we have the cash, we spend it. But if you put in an automation to automate that, to move it out of your spending account, now you switch it from unconscious spending to unconscious saving. Like John said, once that you start to see this reservoir build up, it like flips a switch in your mind that now this is an asset. This is a thing that's growing. I don't want to deplete it just without thinking. I want to be more conscious of my decision. I want to be more strategic about if I'm going to deplete from this. It's just your mind sees this asset building and you don't want to affect the growth. Where if it's just this nebulous spending account, you just spend out of it. And so basically all of your increases over your career or your life or your businesses, if they're just in the spending account, they just get spent and we don't even know we're doing it. We're doing it unconsciously. But if you can just automate putting it into a place where it becomes an asset, you really think twice about what you're going to do with it. And so that's, valuing your capital. If you actually can never see your capital growing, you don't value it. It just is this nebulous pool of spendable dollars that you don't put any value on. So it's just a really important mindset shift, but actually seeing it grow and become a thing, an asset, that really does flip a switch in people's minds about not wanting to stop that growth.
Mm-hmm.
So it's really psychologically, it's an interesting phenomenon.
Yeah. Well said, guys. Yes, and if any of our listeners would have questions about how to set up an infinite banking or family banking policy to have this asset in your corner, really the foundation of your financial journey, I'd encourage you guys to check us out. Shoot us an email at thefamilybankingshow@gmail.com, and we would be happy to sit down with you and discuss what this would look like for you and your family. All right, guys. Well, I'm excited for our next episode. I think we're going to have what the cool kids call a banger of an episode.
Easy.
Good tease.
Yeah, I'm excited. John's got some great ideas percolating in his head, and I'm excited for him to get them out and to share it with our audience. All right, guys. Well, thanks again for joining me with this episode, and we'll see you in the next one.
See you guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.